Clayton and Terry, as we have over 50% of class here today. Three out of five, 60%. All right. We got a lot we need to do and discuss. Uh, we don't have a test yet. We got midterm grades next week. Where does that put us with a test next week? Some kind, some way, somehow. I'll give Jonathan a minute to get back. Well, we had you out last night. Sierra had strep throat. Cole didn't hear from her. She is totally volunteering anyway. Cole is. The rest of you are taking for a credit. That's Sarah. She's doing it. It's a work study time. So anyway, I guess Mr. Imwood heard about it. He called me on the road this morning. I got here and I talked to him. And I think the vice president of finance called him because security had a report to her. They made a big deal out of it. Nothing wrong with it because security everybody's going out. Then let's see, she called. I didn't know her name. I would call her yesterday, right on front of that patient. Anyway, she called Mr. Imel. I was in class or something. She talked to Mr. Imel. And depends on how you handle people like that. First night, I just tried to get her to calm down and told her I would talk to Savannah. Knowing that Savannah, now Savannah is spunky and high strung. It's a wonder Savannah had to knock that out the first night. So, anyway, she called Mr. Imel. Mr. Imel told you couldn't expect to get that. He filed a refund in 2 weeks. They may advertise 2 weeks, but they tell you to wait so many weeks. Now, whether Sarah had hit send on e-file or not, doesn't matter. It did get sent and is accepted today. And Mr. Imel, I don't know if he told her she couldn't come back or if when she calls again, he's going to tell her we will not do her taxes again. You know, students who volunteered, I volunteered, you want to get paid for class. It used to, I used to do it for nothing. You all may get credit for class, but we don't have to put up with that stuff. Okay? We're doing it for free. Did you say Hillary, a friend of yours, took her to H&R Block? Paid $450. You remember what her situation was? Was it just nothing? Was she married?
No, she was divorced.
Well, she's single. Get kids? Do the computer program calculates child care.
Amazing return.
Huh?
It was an easy return.
Well, didn't even have to get itemized. They went up to $350 last year, but that's saying that's a lot. But a lot of people are ignorant when it comes to doing taxes. I still think an average person can take a tax program and do the wrong taxes. Tax cut, tax cut, H&R Block, and TurboTax. You all see, good to know some of the rules, but see, it leads you to it. Savannah had a couple last night.
She got that teacher's coat.
Did pretty good. Dr. Mr. LaFong, something or other, he teaches math. 84 years, so. He's been teaching 51 years. He taught high school before that. Darn if I'm gonna teach that lady poetry.
Do what?
Go ahead, Sarah, what's up?
I was kind of like, cool, no. The woman from the bank is calling me back.
That number is nowhere near payer ID for them.
Wow.
Did you get that one figured out at Concord?
She called, we took care of that. So it's a federal ID number is 2 numbers, then 7 numbers. Okay. This number was 2 numbers and 10 numbers. And it cut the last 3 numbers off. So it rejected it.
Oh.
So I called the woman and she verified that number that we had in there plus the 3 more numbers twice to me. And
10 digits? I mean,
12 digits
Right.
altogether. And I knew that was wrong. So I asked Michelle to see if Mike could help us. And he told me to call the main number up there because he's currying. And I called there and spoke to Shirley, and she is in the trust department, and she is going to be calling back.
so it was not our mistake.
No, it was not our mistake. She said that she can't even find the woman's information on her end. So it's got to be on a different end in the bank. So she's going to make several calls, and she'll be calling back, and she'll leave a voicemail message for me.
The social security number is 9 digits, so is the 9 digits.
Yep, and EIN has got 9 digits. And this was 3 more.
Sarah, Savannah and I ran into a problem. I believe, did you have one too, John? Who else had a state return that printed out that was sitting in a hard copy?
And it's not printing it out to say, and every time you print it out, it says do not mail.
No, what it was, Mr. LaFont that paid in estimated taxes, federal took it easy. Savannah couldn't find it on the Virginia program. And we looked and we looked.
Oh, I know where it's at.
You do?
Yeah, it's right in the other taxes section. On federal.
I think on federal?
Yeah, under federal, under taxes.
That's why we didn't find it, we went to Virginia. So there's another taxes under federal. Would that be estimated taxes for federal?
It has state, where you put estimated taxes for federal, it has an option for the state as well.
That's why we didn't find it, so we printed it out for him to mail it.
That's cool. She had my number, she could have messaged me.
Yeah.
But
We
yeah,
looked for it, I couldn't find it, so now we know where it is. Okay.
Yeah. that's where it's at. But thank you, Jonathan, for getting the numbers together and everything in there.
Yeah, John, I think you guys did good last night. You three and Savannah and Terry knocked out about 26 returns in an hour and 45 minutes.
It's like, once that incident happened, kind of like slowed down the rest of the room, honestly. Because it just seemed like everything was going wrong after. I mean, I felt like it did with all my papers. It's weird.
Oh, yeah, that was disruptive. But anyway, be as it may, that's done, it's over with. We're still doing a good service. We'll come across things like that. Sarah said, I wish you had talked to her. Sarah reminded me of one lady I talked to one time. We blackballed her too. And anyway, Sarah said, she was talking to you, Mr. Lester, and you said, you told her. She said, lady, if the damn $15 means that much to you, I'll take it out of my pocket and give it to you. I do remember telling her I would give her $15. She couldn't find out what it was all about. And anyway, Sarah said, after you talked to her, she called me and apologized over and over. So maybe I should have got to talk to that lady. I missed her every which way. She called the other day. Usually I was in class. She called the day I was in class. I'm going to talk to her today. And I won't fool with her anyway. But, you know, this life, you get burned. Even if you did it with H&R Block and they made a mistake, you still don't go in raising hell. You still are nice even though you paid for the service. and still in this country, being nice gets you further than being obnoxious, arrogant, and stupid. Okay? If you don't have, in her case, ignorance, we can overcome. If there's a topic in taxes and we're ignorant about it, we can learn and overcome ignorance. Some people are stupid and they cannot overcome stupidity. Okay? That's going to be the way it's be as long as we all live. Okay? Now, we've got to have a test Tuesday. So try to come to class, all of you. That means Clayton and Terry. Now, we'll see how well we do. It may be, since the true, false, and multiple choice, I'll let you take it home Tuesday and bring it back Thursday. I do want you to dig in on these chapters. We've neglected these chapters. I feel like we did the credits. Chapter 14, okay. All right. Now, the other two chapters on the test is 11 and 12. Chapter 11, I think you're going to be okay. Go back and hit some highlights and just tell you what you can be studying for or reading about. Even though it's an open book test, you don't want to have to take time to look up every answer. Now, this chapter we looked over pretty good. Some old accounting topics. All right. Now, we looked over accounting periods. A couple exceptions with IRS, and that's a 53-week return. If I open up a book, a business last week in December, I wouldn't do a tax return for 2019. I'd wait and do it at the end of 20. All right, we also discussed returns for periods of less than 12 months. If I started a business in September, I'd probably do a tax return for 2019, September, October, November, and December. That's a short return. That's perfectly legal. Now, accounting methods, we looked at cash and accrual. You should know those. But now I hope I put questions on the test that makes you dig in to see what the IRS differences are with prepaids and unearned. So look up prepaids and unearned under accruals for tax purposes. The hybrid method was if you got accounts payable, accounts receivable, you can use accrual basis and everything else cash. Now, this country, accounting is based on the accrual method. We want to compare General Motors to Ford, they've got the accrual method. We want to compare Goodyear to Firestone, they've got the accrual method. So using the cash method. Doctors at one time did because the patient didn't pay them. Even if they had accounts receivable on the books, they ended up writing what was bad debt. So they didn't put accounts receivable on the book. They just kept notes of who owed. And when I did trucking companies, I did some small businesses, I recommended they stay on the cash basis. Even a couple of other trucking companies I incorporated, I requested they stay on the cash basis. Wasn't a lot of difference anyway. In December there, they may have owed $3,000 or $4,000. They couldn't take it to on a cash basis. But mining companies may have owed them $5,000 or $6,000. They didn't have to report his income. So it didn't make a lot of difference. Now I do tax returns still. I fill out a Schedule C on cash basis. I don't have any accounts receivable anyway. Okay?
Do you have to, like you said, you do taxes, right?
Yeah.
Do you have to report your income that you make when doing that?
Sure.
Then just like, how do you figure that out? You don't get a W-2.
I don't give myself a W-2. I don't give myself a 1099.
So what do? Just calculate what all you make and throw it in
Yeah.
other income?
Like I do taxes for when I was over. Still got a few other people. I know what I charge. Well, I can keep a record of what I charge. Let's say I charged $3,000 last year. What expenses do I have? I buy a TurboTax. I get home and business, costs $80. I take that off. That's an expense. If I deliver a tax return, which I do sometimes, I'll take off mileage, 54 some cents a mile. That's an expense. If I would appreciate my computer, I think I'd appreciate it now. I take depreciation as expense. I don't take home office because I don't have a room exclusively for tax purposes. Well, you can take home office. And I can take part of the electricity and all that. So I don't take home office. Most I have is, my payment for the printer, supplies, gasoline if I deliver the return, and a tax program. I don't have any expenses. So you put that on Schedule C, pay taxes on it. And if it's over $400, you pay Social Security tax on it, self-employment tax. So that's a simple Schedule C, Jonathan. That's what you're talking about. All right. Now we went to inventories. And I showed you on a tax return. They like cost, or they like market, or they like the lower of cost to market. Now, one thing about inventories. All right, do you remember what FOB destination, FOB shipping point means? What does FOB destination mean? Not your cheese, it arrives. Well, what if it's FOB shipping point? It's yours. You counted it in inventory even though it hadn't came yet. Okay? How about if you sell something? You deliver it in December, it's sold, it's not in inventory. Well, if you sold it, hadn't delivered it yet, is it your inventory? Should not be. All right? Because it shows up in sales, and cost of goods sold. So you'll have some little problems like that. Now, inventory, they do recognize LIFO, they do recognize FIFO. Go down to the bottom of page 12 real quick. Now, we know inventory. Sometimes you have stuff added to it. All right, if you bought 100 bushels of apples, what can you add to apples? Well, you may bag them up, 10 per bag, to sell them to the grocery store. So you're adding to the cost of your inventory when you put them in bags. Now, when I was in the used car business, if I had to put a sticker on them, tires on them, have them detailed, waxed, or anything, I added on to the cost of the car. So that added on to my inventory. And John, you were talking about taxes. I had a tax business for a couple of years. I had a lot of good tax clients. Most of them stayed with me until they died, since I've outlived everybody. So, whether they went to Florida, they send their tax returns back to me to do. One of my last ones from no tax business days, she died back in January, and her daughter-in-law hunted me down. And they're going to send me her tax stuff to do her last return. So forth. So anyway, we run into those things. Now, one other return, that was my call. This lady come in with a W-2 for her husband been dead 2 years ago. You look at the tax law, if they'd had kids, she could have done surviving widow, include his income, maybe gotten away with it. If you were death, they're going to file a joint return. Well, she should have done. 2 years later with no kids. She had to file single last year, but she didn't get married again, so she had to file single this year. That's the way I told the student to file on her, which I'm right. Now on him, I'm not sure if I'm right or not. I told her just go ahead and file single for him. All right? Hers has went through and been approved, his has not. Sure, they know it's dead. All right? We tried to get it through. If it don't go through, I don't know what we should do. But the research. Couldn't save him as a dependent, he's dead. Could be married voluntarily, he's dead. Don't do a separate return. Probably we could have got, maybe got away with it, we've done separate return. I don't know. Sometimes it's a hard call. When we're doing taxes up there, we got 30-some people. I just have to make a decision and run with it. Okay. All right. So look over inventories. Now, a couple of parts here I'm not happy with. Go to page 16. This is going to be on the test. Completed contract method. You count the revenue in the year you get paid. Almost like cash basis. When do you count the expenses? All right. Percentage of completion method. I like this method. If you've completed 40%, then you claim 40% of the gross profit. Take your expenses. Modified method of completion. So we're going to look at example 21, page 16. All right, a contractor enters into a contract to construct a bridge for $1,000,004. At the onset, the contract estimated it will cost $1,000,002. How much money is the contractor going to make? $1,000,002 subtracted from $1,000,004. How much is he going to make? Gross profit. All right. Actual cost in 2019 are less than expected, amounted to $600,000. The profits reported in both years. Okay, now 2018, he entered into a contract. All right. Actual cost in 2018 was $540,000. 40% of the $1,000,002. Total estimated cost. Actual cost 2019 are less than expected and are $600,000. Well, 600,000 and 5.4 is 11.4. So he's going to make 60,000 more than he thought. Here's the way it is, though, in 2018. Nothing was completed. Nothing is reported. In 2019, the revenue was 1.4, the whole thing. You take the expenses of 1.14, the whole thing, and you had a gross profit of 260. All right, now to continue with that, though, on page 17, percentage of completion. Now, did it say what percent was complete? Did it say what percent was complete? We got the cost incurred, that's no problem. Where do we get to 630?
Yeah. 540.
Do what now?
They took 540,000 divided by 1,000,000 times that.
Okay. That was the gross profit. Okay. All right, so look at those examples. Now, the installment sales method, I'm not a whole lot concerned about that. Now, sometimes people sell land on the installment plan. All right. Okay. The installment method, sometimes land. And then, of course, a car dealership, used cars, you might sell on installment method. Furniture is the installment method, so forth. And even in principles accounting, we study installment method for interest. Now, look at the example on page 16. Compute the gross profit from the sale. Selling price, blank, blank, blank. I'd rather have real numbers, so let's go over to page 19. Selling price is 200, basis is 60, selling expense 13, depreciation recapture. So your gross profit is 117,000. Now take that 117,000, let's see. Greater of gross profit of 117 or selling price minus mortgage assumed by the purchaser. So I don't know how much was the mortgage on this property. It must have been 50,000. All right, if you sell it for 200, but the mortgage is 50, they assume that mortgage. All right, assumed by the purchaser, 150,000. It'll be 150,000. The mortgage assumed is 150,000. Yeah. Which one is it? So new W-2. Know how to do it? Before he prints it, we'll look at it. This one, we need all the facts, and we probably should have read the information at the bottom of page 18. If we read it, it makes more sense. She's a cash basis tax rate. She sells equipment for 200. It cost 70, and 10 of them may serve depreciation. All right, that would leave the basis only 60 at that time. All right, the 10,000 depreciation must be recaptured as ordinary income under section 1245. The buyer assumes the existing mortgage of 50,000, pays 10 down, and agrees. All right, now how much are you getting out of it? Go to page 18 with me. You sell it for 200,000, right? Now they assume a mortgage of 50, pay 10 down, and agrees to pay 10 a year for 14 years. Okay, how much is 10 a year for 14 years? How much is 10,000 a year for 14 years? All right, now pay 10 down, add 10 to the 140, make 150. All right, you're going to pay off for the mortgage 50. That's same as getting 50 more, so it's sold for 200. They assume the mortgage. You'll get 200 out of this. All right, because they're paying off the mortgage. But look at the steps. Selling price is 200 minus 60, minus the depreciation recapture, minus selling expense 117. Step 2, greater of gross profit 117 or selling price minus mortgage, which is 150. Selling price of 200 minus the mortgage. Compute the gross profit. 117,000 divided by 150 is 78%. Now multiply 10,000 times 78%. That's how much gross profit you will report every year for 14 payments. All right, if you look down through there, it's going to end up being what I said, no matter how many calculations they do. Compute the gain to be reported in year of sale. Principal received times 78%, you're going to report a $7,800 gain. And you're going to recapture that depreciation, so it's 17,800. For all the years thereafter, it'll be 7,800. Now, there's a form that goes on, makes it easy. So, all right. I want to say a couple of things about inputted interest on page 22. Okay, as a business, you go out and buy a piece of equipment, and you pay $200,000 for it. You want it on installment plan for 5 years, that's $40,000 a year. Now, they may charge you 8% interest. So if you pay $40,000 a year plus interest, that's no problem. That's not inputted. But let's say we're going to sell you this piece of equipment for $200,000 with no interest. And you pay payments of $40,000 a year for 5 years. Well, we know they've upped that sales price. And they've got interest included in that $40,000. That's called inputted interest. They've got interest included in that 40. So what they're going to do is give you the going market rate. And you've got an interest expense on that inputted interest. It works reverse. For the seller of that equipment, they got revenue. Decreases their, well, they got to report it whether it's gross profit or interest revenue. It's going to equal out. It's the same for them. Anyway, so read over that. Now, the sale of a personal residence, they've already mentioned that here. We'll get that later. Change of an accounting method. You got to have permission from IRS. There is a form. You can look that up. Page 1124. There are places on a corporation tax return for page 24. If the shareholders got loans from the corporation, or if the corporation got loans from the shareholder. Now, I'm going to leave you on your own on that chapter, assuming that you're going to take it home and open book. Now, I want you to look at page 17. I want you to look at the example we had in the book. Line 5, we sold it for $200,000. Line 6, we had a mortgage. Line 7 is the difference. Line 8 is the cost. Line 9 is the depreciation. Line 10 is the adjusted basis. Line 11 is commission, $13,000. Line 12 is depreciation recapture. When you sell something, you got to recapture depreciation. If you took the 179 deduction. Now, if I took 2,000 depreciation every year and I sell something, there's nothing to recapture. But if I took the 179 depreciation, there's a recapture. All right, so forward, look at line 13. Now we've got, how do we get to 83,000? 60 plus 13 plus 10, 83. That left us 117. Go down to 18, there's 150. Calculate, get to 78%. You collected 10,000, you report 7,800. Now, when you look at this form, does that not make it easy? You look at this form and you follow it. Would that make it easy? It does. Now, Hillary was talking about in the last class, she knew somebody that got a D out of taxes at Valley College, Hillary. So, but they went to H&R Block and passed H&R Block's test with flying colors. That's possible, because H&R Block tells you to follow the forms. When I had taxes, the instructor never had us to do a problem on the form. He never had us to, we're behind on doing problems too. He never showed us the form. It was all theory, all book knowledge. The only thing he did good that semester, he told about that little whorehouse in Tennessee. I told you all that story, didn't I? You remember it, Cole? Don't remember? Well, when I was taking taxes 1, he was telling me it was in the Tennessee paper. There was a whorehouse in Tennessee. They had to audit her. She was illegal. She kept no records. So they went in and improved her income. What they did, they went down to the dry cleaner. They found out how many sheets she had cleaned for the whole year. Divided it by 2 and multiplied it by the going rate, and that was her revenue. That's what they taxed her on. Now she had to prove if she had rent expense, electric, telephone, medicines, or whatever. She had to prove all her expenses. All right. So that chapter I think you're going to be okay with. I've asked you forever and a day. I've asked you for a long time. Would you work the even problems on chapter 14? Credit. Would you work the even problems on chapter 11? Counting methods and inventory, installment sales, percentage, and so on. Now, Tuesday, if I give you a test take home, I'll go over a few problems in chapter 11. But 12 is very important. Property transaction, non-taxable exchanges. We've not done diddly squat with chapter 12. All right. We started off a little bit. We trade a computer for another computer. That's a like kind of exchange, isn't it? But your book somewhere ago, I even read it to you. An apartment building in the city, you can trade it for a farm in the country. That's like cow. A male cow for a female cow is not like property. I don't get that one. I guess they're used for different purposes, for milk or breeding or what have you. So look at page 2. Now it's real simple. Let me bring up the notepad. Right now, Jonathan has a computer he paid $1,000 for. Cole has a computer he paid $800 for. And they're using it in business. So Jonathan depreciated his $300. His basis was $7. Cole had to depreciate his 200. His basis was 6. Now the fair market value of Jonathan's was 700. Fair market value of Cole's was 700. They trade even. Now, if you trade even, there's no tax exchange, right? Now, Jonathan does not have a gain or loss because his basis equal to fair market value. He does not have a gain or loss. Now, if he bought this in June of 17, when he gets this computer from Cole, he pretends he bought it in 6/17. If Cole bought his on 8/18, when he trades with Jonathan, you pretend you bought that computer on 8/18. Now, Cole here, how much of a gain does Cole have? He has 100, don't he? That's called realized, but it's not recognized. Since it's a tax-free exchange, you don't pay tax to the IRS. So this is some of the things I want you to look at. What date do you go back to? Now, with Jonathan, when you sell your computer, what's its basis? Cole, when you sell your computer, what's its basis? Right. It works out in the long run. Okay? All right. So that's some of the things. Now, the only thing we can throw into the mix here, guys, I gave you the same scenario. Remember those figures. Jonathan, you got Cole's computer that had a fair market value of 7, right? And Cole got yours that had a fair market value of 700. But remember the numbers I put up there. Jonathan, what if you give Cole, since this is a newer computer, $200 boot? Now you remember the basis of your computer, Jonathan? How much was it? All right, if you give him 200 boot, your new basis is going to be 900. Okay. Now, Cole.
How's it called a boot?
Well, did you ever trade cars and give boot? Hilly, have you ever traded cars and give boot? You ever traded husbands and gave boot? All right, Jonathan, when I bought my truck, let's say it was priced at $45,000. I had an 05 Ford pickup. I don't know what they gave me out of it. Let's say 15. So they gave me 15 out of mine on a $45,000 truck. So I had to pay boot $30,000. That's the difference. If you trade something in, that's all it is. All right, Jonathan, your basis goes to 900. It goes back to when you bought it. Now, Cole, on the other hand, got a computer worth 700. He got $200 to boot. All right. Cole's basis was how much? His basis stays the same at 600. Now, how much gain did Cole have? He had a $300 gain, but he has a realized gain of 300, but he only recognized his cash boot 200. That's not too bad concept. If you follow through, we look at some problems later on. Now, what's this designed for? I've got an investment piece of land I gave $20,000 for. I know I can sell it for 30. All right. Now he already has an investment piece of land. All right. He's willing to trade it to me even for my land. Now, Hillary can sell hers for $30,000 too. You may have only given 15 for it. So if Hillary sells hers for 30,000, pay 15 for it, how much you pay taxes on it? 15 grand. Unless I pay taxes on it, I gave 20 and sold it for 30. What if I'm in a 20% tax bracket? What's 20% of 10,000? I paid 2,000 taxes this year. Same with Hillary. Well, she was in a 25% tax bracket. And what? Hers 15. 25 plus 1250. Oh, 25 of this must be half of that on 5,000. Okay. Now, but if Hillary and I trade properties, how much we pay in tax? That's a good thing about lifetime exchange. Certain things qualify us and certain things don't. All right, now you've seen the purpose of it. And three-party exchanges, I don't recommend those. I want you to go to page 5. Go to page 5. I want you to take a minute and read 13, 14, 15, 16 examples. Read those 4 examples. Still got a cold, Joe?
Me?
Yeah.
It's like going away. Still.
So I hope mine goes away this weekend. Sinuses, head cold, whatever it is, it's miserable though.
This is like the 3rd week.
Really?
Probably should have went to the doctor first.
I probably should have too. Sometimes we don't do. Hopefully we'll be better by tomorrow. Okay, if you read these examples, we'll move on. Receipt of boot. We just discussed that a little bit. All right, if you sell a property received, on page 6, it's going to tell you how to do your basis, which I discussed. It's going to tell you what your holding period is, which I discussed. All right. Real quick on page 9. An involuntary conversion. I thought I discussed that a little bit. What is an involuntary conversion, Hillary? Well, you what? Right. The power company can put a line across your property. You don't have a choice. That's eminent domain. Now, what happens when the highway comes and takes 10 feet of your property and grades it out? You don't have a choice. Well, that's not total involuntary conversion. All right? That's just part. And they'll pay you for that. It reduces your basis. You don't even report the income. Now, Hillary has a house at the lake. The lake got high. What if it washed off her total house? That's involuntary, isn't it? So a fire, a flood, a mudslide, a tornado, a hurricane are involuntary conversion. But the government can force you also to get rid of your property, okay? Which is also involuntary conversion. All right. Now there's different rules on involuntary conversion. Now this is pretty simple example. Now what if Hillary's house cost her $50,000? Whoops. Now we know the house and land goes together. Let's assume her land didn't wash off. Without the lake, it's possible even that land washes off. Now, out in California, I knew of one case, and I've been up those roads where they have a lot of cliffs overlooking the ocean. And there's a house built out here on top of one of these big cliffs that overlooks the ocean. Now, here's a little bit of land in front of this house. They are built on cliffs. All right. Now, what if that cliff decided to slide down here behind the house? That house slid down here. It is not destroyed, but you can't get to it. All right. That house moved from here to here. There's no road into it now. You'll need a rope ladder to go down to your house. That's still an involuntary conversion. Now in Hillary's case, her house, she paid $50,000 for. It washed away. The insurance company gave her $75,000. Does she have a gain? You report it like a gain, like a sale. You paid gain on it. All right. What the insurance company only gave her $45,000 what she got. A loss. Now, what if the insurance company gave her $20,000 for damages? And she puts $15,000 back in the house. What's her basis? Now what? I believe you went the wrong way. Go the other direction. What? $45,000. All right, now how much did she pay for her house? All right, she paid $50,000 for it. Now if the insurance gives her $20,000 for it, she puts that $20,000 in her pocket and runs. What's her basis in her house? Now what if she decides to put $15,000 of that insurance back on it? $45,000. Keep that in mind. Insurance money. Now, one other scenario here. Hillary's got a $50,000 home. And Hillary, a lot of those people down at the lake, their campers got flooded. Those down near the lake. A lot of them might not have had flood insurance. They didn't think they'd ever have a flood at a campground. And sometimes you have to request flood insurance. Now, a lot of people in Buchanan County can't get flood insurance because floods were normal. The insurance companies would not cover them. Okay, what if Hillary gets $20,000 out of the insurance company, but she really fixes up her house? She puts that 20 in plus 10 more. So Hillary's going to put $30,000 into that house now. What's her basis? What? Go the other direction. All right, do it like we did before. She puts that money in her pocket from the insurance company. What she got in that house? Then she's going to put in 30 more. What she got in it? That's your basis. So be careful which direction to go with these bases. I always say pretend you put that in the bank. And your basis goes back to 30. All right. Tax treatment of gains due to involuntary conversion. Now, what I want you to do is look up how long it takes you to get replacement property. Look at page 12. There may be a fire. I want you to look up the date that you can replace your property. They'll be doing that between now and Tuesday. Trying to find a list of those dates. I can't find it. Look at example 43, page 14. On December 8th, Craig's business property was destroyed by fire. Craig received insurance 2019 and elects to defer recognition of gain. He must replace the property between December 8th, 18 and December 31st what? 2000 what? All right, let's see. That's 21, 20, 19. All right, here's the deal on that one. It didn't say it. Here's what it looks like. You've got 3 years to replace your property after the end of the year it was destroyed. Now, I don't care if it was destroyed on 1/2/18. In this example, when was it destroyed? On 12 what? 18. Now, forget about 18 altogether. Forget about it, no matter when it was destroyed. Now, add 3 years to 18. You got 19, 20, 21, December the 31st. 3 full years. 3 full years after the end of the year it was destroyed. So it didn't matter when you lost it, did it? Okay. So be careful of that. Some of this is 2 years, some is 3 years. Sale of a home, real quickly. I want you to look up those principles. I believe it's 500,000 for a couple, 250,000. Yeah. Okay, Jonathan. Let's say someday she talks you into getting married, and you buy a house. Have you already talked her out of it? Let's say you buy a house. You got a darn good deal on it for 200,000. You kept it for about 10 years. Real estate really went up. You sold it for 750,000. How much of a gain do you have? You only pay taxes on 50,000, all over 500,000. And most likely, Jonathan, you would never sell that house for that good a gain, would you? So anything less than 700,000 is tax free. Sell it for 695,000. All the gain is tax free. That's what's said about our principal residence, okay? All right. So look over the principal residence, and we're going to look some more at this chapter also on Tuesday. So I'm going to let you go today. We got in at least halfway decent class. But Jonathan, when you bring up that amended return, do your best on it. If you can't do it, wait till Tuesday and Sarah will work with you on it.